Hi guys, this is Teacher Party. Welcome to my YouTube channel. I should have the jiggle, guys. Welcome to my YouTube channel. Subscribe, like, and do all the amazing things. Guys, we're still continuing with the conceptual framework. Yippee! Hooray! I see you excited. No. Okay. let's just do this and act as if we're excited. Okay, so this is examples of assets, guys. Okay, so examples for us is like computer software or computer programs. Guys, in practice, company policy will be like, okay, we're not going to record computer software as an asset. We're just going to write it off as an expense the moment it comes in. Sorry, some companies will be like, no, actually, we will capitalize this and all. So I think at a beginner level as a first year, unless otherwise stated, treat it as an asset. There's also prepaid expenses. Guys, in practice, where we usually had prepaid expenses, it's with insurance. Cayman Insurance, like Cayman Insurance is for the directors or the board members. It's ensuring the directors and the board members that in case they make a wrong decision and the company gets sued, the insurance must pay. Or if something just passes their knowledge and they should have been aware of it and they didn't act with foresight or with scrutiny when they were doing their work, then they get sued. That claim, the company will settle it, but then it will take the settlement amount and go and claim it from the insurer. They won't get the equal amount because there's shortfall and access or something, but at least they'll get something to recover from the legal dispute. Now, that insurance, the Cayman Insurance, you usually don't get it like we get it as people. Like, remember, company is a juristic person. So like as people, you would get the policy and pay it monthly. So usually Cayman Insurance with companies is paid once off. Once the financials have been submitted and assessed, and then they see the risk, then they'll give you the insurable amount or the claim amount. Not the claim amount, but the insurance value and then the premium amount. So they'll tell you that this is the invoice. For example, a 3 million worth company, they can insure it for 30,000 for 12 months. Then you have to pay it the moment they give you an invoice so that insurance kicks in. This is, they're not paying into what? Hey, English guys. They're not paying into attention, or they're not paying attention to, that's the right way. They're not paying attention to your financial year end as a company. They're just giving you because you wanted insurance now. So if now it's 15th of Feb 2023, they'll give you an invoice. If say, when do you want the insurance to start? Maybe say, let it start 1st March. So they'll give you an invoice starting from 1st March, ending by the 28th of February. But your financial year end, let's say it's June. So March, April, May, June. So 4 months is the expense. The other months, 8 months, it's not expense, it's an asset. You can still claim back that money because they've not performed a service. Okay. So why am I talking, and what happened to my story about that, guys? Hey, jealous computers. Okay, as we proceed. So I'm still explaining, I think I got passionate when I was explaining prepaid expense. Okay, so accrued income. Guys, this is the money that we know we should be receiving. And the person is taking their sweet time to pay us the money. Let's look at the example for Mr. Price. So Mr. Price might be having okay, so let's say, look at the example for Mr. Price. So Mr. Price might be having a brand that is renting at their shop. You think it's Mr. Price. Let's look here. Shop by occasion. Thank you, because I know this from fashion designers. Mr. Price is selling this brand like the Oak Ridge Formal. Let's assume Mr. Price is housing the brand, but the brand does not belong to Mr. Price. and Mr. Price just has an arrangement or an agreement with the designer that they'll bring their clothes to their shop, and then whatever sales they make from this shop, then but the designer is supposed to pay them commission for them housing their brand. It usually happens with clothing shops. You think a brand belongs to them. Actually, no, they are housing it. They are not really owning the brand. So in this case, you'll always create an accrual as an accountant, because maybe you're going to send the invoice to Oak Ridge after the financial year end, when you already have the total sales. Then you claim commission once. That commission is going to be accrued every month, because it's money that's supposed to be received and it's not received. I hope you understand accrued income. Okay, so if you don't believe this case, there was the guy that designed Happy Socks in South Africa way back, was housed by not Jenny Button, by Stutterfords. I think the shop closed now, and he had that arrangement. So he would just be given a small space in the shop to put his products, and then you will think you'll buy go and pay over the counter. They would have their own arrangement how they pay each other for commission and how the person receives their money. Okay. So machinery. So we're using the Mr. Price example. So machinery, because Mr. Price is not really producing their clothes, they're sourcing it wherever and selling it. So if they were producing their clothes, it would be the sewing machines. I think Rex Trueform was the old supplier in South Africa, and they used to own sewing machines for, okay, Edgar's and others, Stutterfords, and that they used to buy clothes. They're way before the China bubble in terms of supplying clothes. And that company would have machinery like sewing machines. So if Mr. Price was sewing it or sewing its own clothes, it would have sewing machines. Some machinery is the swiping machines. So if Mr. Price paid the bank for those machines to be brought and installed, that is machinery. Okay, so consumables on hand. So that's the stationery. That would be the stationery that the tellers are using, not for sale but for their own purposes, like your like your the no, I lie. That's stationery on hand. Consumables on hand, it can be anything like your cleaning materials, your packing materials. Yeah. You do know, at a shop you wouldn't be buying Sunlight liquid like we buy it at home. You would be buying loads and loads of stuff for cleaning and all. So that would be your consumables on hand. Also, big bulks of sugar, big bulks of tea, big bulks of milk, coffee, those things at year end, there would be consumables on hand. They would not actually be inventory, because you're not, Mr. Price is not selling tea, it's not selling coffee. Okay. If it was a coffee shop, would record it as inventory. So computers, hey guys, we're talking about the teller machines that Mr. Price has. This can be computers, this can be equipment, this can be classified as machinery. That will depend on how Mr. Price classifies these. Those racks, those clothing racks and all that. It will depend if they call it equipment or they call it furniture and fittings. We should have it somewhere. Furniture and fittings here, okay? Plants, so Mr. Price producing its own clothes. It's importing it or sometimes getting it from local suppliers. So the plants would be talking about here in the Mr. Price, it would be your storage when where they receive their shipment and all that. Okay, so the bank balance, if it's positive, it's an asset. If it's negative, it's a liability. Okay, inventory, guys. Mr. Price is in a business of selling clothes, cell phones. So this is inventory, assuming then that Oak Ridge is owned by Mr. Price. Okay, trade debtors, you ladies and gentlemen buying clothes at Mr. Price on account. Okay, Then office supplies on hand, that's the stationery I was talking about, guys. Remember, I said I started by explaining stationery on hand as consumables. I was like, no, I lie. So that is stationery, the pens, pencils, sticky notes, exam pads, all those. That the what is it, printing paper that the staff is using in their daily operations at Mr. Price. Okay, VAT input, that is Mr. Price paying VAT on the imports or paying VAT on the clothes, on their supplies, and then they claim it back from SARS, that's input VAT. Vehicles, so guys, the trucks that go, if Mr. Price owns those trucks, the trucks that go to the airport, not to the airport, they go to the port, like the docking, not to the dock, like the by the sea, Durban, Cape Town, wherever the shipment comes from, that's the right way. The shipment comes from those trucks that pick the shipment or pick the final goods from the suppliers and they take it to the shops. Those are the ones, call those assets. Equipment, I explained. Stationery on hand, I explained. Allowance for credit losses. So Mr. Price knows that if 100 people buy today on credit, looking at the economic state of South Africa and people's morals, chances are 90% of that will be paid. The 10 will not be paid, or 5%. So they must make provision so that the income statement is not shocked by the loss. So they will make provision. So that's the allowance for credit losses. Then accumulated depreciation, that's us. That's the company or Mr. Price reducing the worth of movable assets monthly. So that's it, guys. So I hope you do not struggle to identify assets. So guys, accrued income and prepaid income, I'm just going to have a video on how do you identify it. Okay, so thank you.